All right, today we'll be talking about financial statement analysis. First being profitability. Profitability is the ability of a business to earn a profit. A profit is what is left over of the revenue a business generates after it pays all expenses directly related to the generation of the revenue, such as producing a product and other expenses related to the conduct of the business activities. The inventory turnover ratio will measure how many days it remains in inventory before being sold. An inventory turnover ratio is important as it has implications for cash flows or profitability. Profitability ratios address a very fundamental question. Has the firm earned adequate returns on its investments? Are they making money from what they have purchased to put them in a position of wealth in the black, in a place where they have green cash flow? Two fundamental determinants of firms' profitability and returns on investment are as follows: cost control and efficiency of asset utilization. So cost control is how well has the firm controlled its costs relative to each dollar or firm sale. And then efficiency of asset utilization, how effective is the firm in using assets to generate sales. To asset utilization. Asset utilization is the ratio where it is calculated the total revenue earned for every dollar of the assets a company owns. So an example of this would be with an asset utilization ratio of 52%, a company earned 52 cents for each dollar of its assets held by the company. An increasing asset utilization means the company is being more efficient with each dollar of its assets that it has. The ratio frequently used to compare a company's efficiency over time. So the formula for this would be revenue divided by average total assets. So the more efficient that a company is with each dollar, the more increase in revenue that we will see. And finally, we come to leverage and liquidity. Leverage and liquidity are both terms that refer to an enterprise's state of financial health. They have a few differences. Leverage refers to the enterprise's capacity to meet its long-term financial obligations, and the other, liquidity, refers to the enterprise's ability to pay short-term obligations. The term also refers to a company's ability to sell assets quickly and raise cash.